for these trader chat sessions, I speak about trading the 40-day cycle, and there are various reasons for that, but there probably isn't time to go into all of them now. I'll keep coming back to it, I'm sure, no doubt, in future trader chats. But for now, we're going to be considering trading the 40-day cycle. Which means the 40-day cycle, of course, there are two potential trading opportunities every 40 days. One is going long, in other words, you're going to buy, and one is going short. Okay, so every 3 weeks we're going to be considering entering a trade, either a long trade or a short trade. So over the next 40 days, which is the cycle that we're trading, the 80-day cycle is, of course, going to be pushing down. So I would give that a -1. All right, so you will remember from our previous Zoom scale, we had -2 from the longer cycles, and now we know that the 20-week cycle is pushing up, so that's +1, and the 80-day cycle is pushing down, so that's -1. Okay, so that gives me, if we add all of that up, that gives me a grand total of -2. All right, what does that grand total of -2 mean? Why are we doing this? Well, what I'm working out is, for the cycle that I'm trading, which is the 40-day cycle, what are the longer cycles doing to influence the market? Okay, Hurst cyclic principles are all about, and if you have questions to clarify, I see a message from Benson saying this is interesting. I'm very glad you're finding it interesting. I spend most of my life talking about Hurst cyclic principles and the markets, and so if there's anything I'm not making clear, or if I'm sort of jumping to conclusions, please ask questions. Hurst cyclic principles are all about the fact that the price movements of financial markets are influenced by multiple cycles. Okay, there are lots and lots of cycles, in fact an infinite number, but multiple cycles are causing prices to move the way they move. Okay, there are also other things such as random noise and fundamental events and so on, but the sort of basic thrust of it is that the aspect of financial markets that we can analyze are influenced by multiple cycles. So now when we're about to trade the 40-day cycle, we don't just look at the analysis and say, what's the 40-day cycle about to do? We do that as well, but we don't just do that. Very importantly, we must ask ourselves what all the other cycles are doing, and in particular, what are all the longer cycles doing? Okay, because the longer cycles are influencing the market just as much as the 40-day cycle and all other cycles. Okay, so what I've done is I've looked at all the longer cycles and I've worked out very simply, is each one of those longer cycles moving up or moving down? Because if a cycle is moving up, it means it is causing prices to move up. If it's moving down, it means it's pushing prices down. Okay, so, and I simply added those up, as you've just seen. And the grand total of all cycles that we are able to analyze on this particular chart, the grand total is this total here of -2. What that actually means is that all cycles longer than the 40-day cycle are, in general, there are a total of 2 cycles pushing down. Okay? So 2 cycles pushing down might not sound very serious to you. In fact, it is quite serious. When 2 cycles are pushing down, generally, there is quite a lot of downward pressure on the market. Okay? So, what does that mean? Well, what it means is that in the next 40-day cycle, and so now what we need to do is zoom in even further and have a look at what the next 40-day cycle is all about. Let me zoom into this kind of scale. Okay, now at the foot of the chart you will see a pile of diamonds, and here they are. Here is a pile of diamonds over there under a date early in March, 6th or 7th of March. Okay, that pile of diamonds indicates that the software Ascension Trader believes that a trough of the 20-week cycle occurred in the first week of March. How do I know it's 20 weeks? Because because of the color coding of that topmost diamond. That topmost diamond is green, and it relates to the 20-week cycle. Okay, and there you can see at the far right of the chart, it says there 20 weeks, which is the actual average wavelength of that cycle at the moment, is 20 weeks. Okay, so the most recent trough of the 20-week cycle occurred early in March. What has been happening since then? Well, of course, the 20-week cycle has been bouncing up, has been causing price to move up. The 80-day cycle experienced a synchronous trough. In other words, it had a trough on exactly the same day, as is indicated by that cyan-colored diamond directly beneath the 20-week cycle diamond. So the 80-day cycle has also been bouncing up. Okay, the 40-day cycle has been bouncing up, and of course each cycle is expected to form a trough one wavelength later. So when is the next trough of the 40-day cycle? As you can see, it is presented by this circle and whiskers. In fact, the term circle and whiskers was coined by Australian members of our beta testing team when we were beta testing Sentient Trader. They coined the term circle and whiskers because the circle represents the exact date on which the next trough of that particular cycle is expected. And to each side of that circle, as you can see, there is a line extending to the left and to the right, and those lines represent the range of time in which that trough could be expected. Okay? So if I was to draw the 40-day cycle trough, the 40-day cycle very roughly, okay, it experienced a trough here in early March. It's expected to go up and then come down to a trough here. Okay, then of course it's expected to bounce again. All right. What about the shorter cycles? Well, the 20-day cycle experienced. Let me just clear this drawing. I'm doing so much drawing on the chart that you can't see anything anymore. What about the 20-day cycle? Well, the 20-day cycle experienced a trough there, as you can see from that diamond, went up and experienced another trough here. There's another diamond. Then it's going up, and it's expected to come down and form another trough over here. Okay, so that's what's happening to all of these cycles. What about the 10-day cycle? Well, the 10-day cycle went up and bounced, went up and bounced into a trough, went up and bounced into a trough, and went up and is expected to come down over here again. So what's happening right now? Well, right at the moment, the 40-day cycle, which bounced from early March, went up and formed a peak, is coming down and is expected to form a trough sometime soon. Okay. When is it expected to form a trough? Well, it's expected to form a trough if I highlight that day on which that circle has been plotted. You will see that is 6 days in the future. So it's expected to form a trough on the 18th of April. Could it have formed a trough yesterday? Because look what happened yesterday. The price came down and bounced up again. And yes, it is possible, because if we highlight yesterday, you will notice that yesterday falls within that line. So it is possible that that 40-day cycle trough actually occurred yesterday. Okay, so the 40-day cycle, the cycle that I've said we have chosen to trade, has bounced out of a trough which might have occurred yesterday and is now heading up. Okay, so what trading decisions are we going to be making? Well, the first thing you do when you're going to make a trading decision is you, of course, look at your analysis and everything, but you ask yourself, what is the cycle that I'm trading presently doing? I've just answered that question. The cycle that I'm doing is about to, or possibly has yesterday, bounced out of a trough. All right. When a cycle bounces out of a trough, what should you think about doing? Well, you should think about buying, of course. Okay. According to Hurst cyclic principles, there are 2 potential trades per cycle. Sentient Trader has an alternative trading methodology called the Sentient Trading Methodology, which gets a little more complicated and presents 4 trading opportunities, but we won't discuss that just at the moment. There are 2 potential trading opportunities for every cycle. The first one is to buy when the cycle causes prices to move up. And the second trading opportunity is to sell when the cycle moves down. Okay, so those are your two trading opportunities. When a cycle is about to bounce out of a trough, then you should be considering buying. And when a cycle turns down and starts heading down towards its next trough, you should consider selling. But of course, it's not quite as simple as that, because remember, the biggest sort of principle, if you like, or the biggest golden rule about Hurst cyclic principles is that multiple cycles affect price movements. So it's all very well for us to have identified that the 40-day cycle is now bouncing up and we should therefore consider buying. We must answer the question of what are all the other cycles doing? In particular, what are the longer cycles doing? All right, so now we have identified that the longer cycles are generally pushing down on the market. In fact, with a total of -2. In other words, there is a total pressure of 2 long cycles pushing down on the market at the moment. Okay, so I've said we should possibly consider buying because the 40-day cycle is bouncing out of a trough. Should you consider buying when 2 longer cycles are pushing down on the market? The answer to that question is definitely no. Okay? You should only be taking trades when everything is working in your favor. And by everything working in your favor, that means that you need to have as many cycles as possible working in your favor. So taking a long trade when 2 long cycles are pushing downwards is really not recommended. Okay, if you are an experienced trader, and I see several experienced traders with us today, so some of those experienced traders might be considering taking a long trade under this particular set of circumstances. But you do that with your eyes wide open and understanding that there are 2 longer cycles, or a total sum of 2 longer cycles pushing down on the market. Okay, so if you're an experienced trader, you might consider it, particularly if you're just getting started, then you wouldn't consider it at all. Hurst recommended that when making trading decisions, you don't necessarily have to look at all the longer cycles, which is what I have just done. Hurst recommended that, in fact, when you're making trading decisions, you only need to look at the 2 cycles longer than the cycle that you're trading, and you make decisions purely on the basis of those 2 cycles. So let's do that. I recommend you only do this when you become more experienced with trading using Hurst cyclic principles. But let's do it. What are the 2 cycles longer than the 40-day cycle? Well, the next longer cycle is the 80-day cycle. So in which direction is the 80-day cycle going to be pushing the market in the course of, in the period of time in which we're considering taking a trade? Okay, it's important that you're clear about that. We are considering entering a trade